Okay, what if I told you that the real secret to crushing it in the financial markets has nothing to do with predicting the future? In fact, what if the secret is to stop trying to predict anything at all? That sounds completely backwards, I know, but it's the exact philosophy that turned a particle physicist into an absolute trading legend. So let's get into it.
So the guy we're talking about is Samir Varma. And yeah, he's a PhD particle physicist. For over 30 years, he's done what most people think is pretty much impossible. He's consistently beaten the market. But his journey didn't start with chasing money. It started when his career path got blown up, forcing him to apply the hardcore rigor of physics to the total chaos of the markets.
Think about it. When your whole job is to figure out the fundamental laws of the universe, you're looking for order, for rules that always apply. But the market? Well, the market is a whole different animal. When Varma brought that physicist's brain to Wall Street, he found out the rules were completely different. And that led him to this incredibly powerful and kind of weird insight.
Yup, you heard that right. The absolute key to his success for decades was to stop trying to forecast what was going to happen next. He stopped trying to outsmart a system that he calls computationally irreducible. That's a fancy way of saying it's so insanely complex you just can't know its future state by looking at its present one. So, if you're not predicting, what on earth are you doing?
Well, the whole story starts when the US Congress, of all things, basically threw his life a massive curveball.
Back in 1993, this huge, amazing physics project he was working on gets canceled. Just like that, he's out of a job. But then he reads this article about chaos theory in the markets. Now, he'd actually published papers on chaos theory, so he was skeptical, but he was hooked. He starts his own company, and pretty soon he's a pioneer, using this high-level math to trade S&P 500 futures. But you know what? The biggest breakthrough he had wasn't in the math. It was in psychology.
He realized that having a winning strategy means nothing if that strategy doesn't actually fit your personality. He calls this congruency. I mean, it makes perfect sense, right? You can have the best trading edge in the world, but if you can't actually execute it over and over again, it's useless. And you'll never be consistent if your strategy is constantly fighting who you are as a person. Sooner or later, you're gonna break, and you'll probably break at the worst possible time.
Let's look at the two main styles to really see what this means. You got trend followers. These guys might lose on like 70% of their trades, but those few wins are absolutely massive. To do this, you have to be okay with being wrong, a lot. On the flip side, you have counter-trend traders. They win all the time. Lots of small, satisfying gains, but they have to live with the knowledge that one day, a rare but catastrophic loss could just wipe out everything. It's the same market, but psychologically, they're two completely different worlds. So you have to be really honest with yourself. Can you actually sleep if you're holding a big position overnight? If the answer's no, you're a day trader, period. Does a long losing streak make you want to throw your computer out the window? Then trend following is probably not for you. Varma, for example, says he hates making a ton of decisions, which is exactly why he built a long-term, systematic style. It all starts with knowing who you are.
Okay, so once you've figured out your own psychology, the next step is this huge mental shift. You have to stop predicting and start reacting.
And this quote, this is a lesson every single trader learns, usually the hard way. The market absolutely loves to punish arrogance. Varma realized that trying to figure out why the market was moving was just a waste of time. He learned that thinking you've got it all figured out is just about the most expensive mistake you can possibly make.
So he just stopped. He gave up on being exactly right about the future, and instead focused on being approximately right about the present. Instead of forecasting what the risk will be tomorrow, he built systems to identify what the risk is right now. Is the market in a high-risk mode or a low-risk mode? That's it. That's the only question he tries to answer.
And this chart shows you why that's so powerful. Just look at this super simple model for the S&P 500. Historically, when the price is above its 200-day moving average, you capture about 2/3 of the gains for only about 1/3 of the risk. But look what happens when it's below that line. It totally flips. Now you're taking on 2/3 of the risk for only 1/3 of the reward. It's not one market, it's a market that exists in different regimes. And reacting just means you change how you play based on the regime you're in today.
What's really cool is that this way of thinking also exposes the big weaknesses of the so-called smart money. You know, the giant hedge funds that most retail traders think they can't possibly compete with.
The truth is, these huge institutions are often handcuffed. They have massive groupthink problems because they all hire the same Ivy League grads who all have the same ideas. Their risk models can be really rigid and honestly kind of dumb, like having an arbitrary 7% drawdown limit that forces them to sell everything right at the bottom. And frankly, a lot of them have just become marketing machines, better at gathering assets than they are at actually growing them.
You know, the legendary investor Warren Buffett won a $1 million bet proving this exact point. Between their structural flaws and their crazy high fees, a simple, cheap index fund will actually outperform most of them in the long run. The biggest edge you have as an individual is your freedom. You don't have those same constraints.
This reactive mindset also clears up a huge fear for a lot of retail traders, this idea that some invisible force is out there hunting their stops. Come on, we've all felt this, right? The price goes down just far enough to hit your stop loss, and then boom, it immediately reverses and takes off without you. It feels personal. It feels like somebody is targeting you. But the reality is way less of a conspiracy and a lot more, well, mechanical.
The whole thing comes down to something called an iceberg order. See, when a giant pension fund wants to buy 1 million shares of something, they don't just put in one huge order. That would scare the market and move the price against them. Instead, a smart algorithm breaks that massive order up into hundreds of tiny little pieces, so you only ever see the tip of the iceberg.
So it's not a hunt for your stop, it's a search for liquidity. That institution's algorithm needs to find shares to buy or sell. So where is there a guaranteed pool of orders just sitting there? Right where everybody puts their stop losses. The algorithm just naturally goes to where the orders are. Varma says a trader's job is not to fight this, but to become a leech on the whale. You spot the big institutional flow, and you just hitch a ride. It's not about predicting where the whale goes, it's about having a process to react when you see it making waves.
So, if we pull all this together, finding your personality fit, reacting instead of predicting, and understanding the market's mechanics, what's the big takeaway? Varma's advice is surprisingly simple. You need to make your trading as boring as possible. That's right, excitement is your enemy. Profitability comes from a robust, repeatable process. First, write everything down, your entry, your exit, your risk, before you ever put a single dollar on the line. Second, test those rules against history. But third, and this is that physicist touch, you have to actively try to break your own system. Add random noise and errors to your data. If your system still works, you might have something real. If it completely falls apart, you probably just got lucky in your backtest.
And that brings us to the most important lesson of all. A good process that leads to a loss is just bad luck. You can live with that and stick with the process. But a bad process that happens to lead to a win, that's dangerous because it teaches you the wrong lesson and reinforces bad habits that will eventually completely blow you up. The process is everything.
So, as we wrap this up, here's the question you really need to ask yourself. Is your trading designed to follow a disciplined, tested, maybe even boring process for long-term profit? Or are you just in it for the thrill, the action, the excitement of the gamble? Because your answer to that question will probably define your entire future as a trader.